Hi guys, I'm Karunya Rao, and in Ideas for Profit, we tell you which broking stock looks the most promising. The outbreak of pandemic has brought about a significant change in the pecking order of the broking sector. Angel broking has moved ahead of ICICI Securities and grown into the third largest broker with more active clients than ICICI Securities as of July end, according to NSE data. Angel's exponential growth is reflected in its stock performance as well. While ICICI Securities gained 58% YTD, Angel broking has risen by more than 250% during the same period. Consequently, ICICI Securities trades at a valuation discount to Angel broking, which we think is unreasonable. There's more than a reason to prefer ICICI Securities over Angel broking, and we tell you what they are. The emergence of discount brokers has completely changed the competitive landscape of the broking industry over the last 5 to 6 years. The incumbents lost market share as new age brokers garnered more clients through their online trading platforms, especially by offering lower and flat fee structures. New age brokers have rapidly added more clients, leaving behind many traditional full-service brokers. For instance, Zerodha enjoys more market share now than the combined share of ICICI Securities, HDFC Securities and Kotak Securities in terms of active clients on NSE. The business of discount brokers got a further boost after the outbreak of COVID as many young traders flocked to stock trading apps in growing numbers. COVID-19 has really turned out to be a key catalyst for these low-cost discount brokers, with nearly 70% of the current client base being added after the outbreak. While discount brokers have garnered more than 50% share in terms of active clients until the end of July from 17% at the end of FY19, their profitability still remains low. With the exception of Zerodha and Angel, discount brokers the likes of Upstocks and Grow are burning cash. Currently, they're growing on the back of the huge funding available in private markets at fancy valuations. Consider the case of Grow. It posted a revenue of 1 crore and a loss of 8 crores in FY20. Despite the insignificant financials, Grow raised $83 million in April 21, valuing the company slightly above $1 billion. Angel, in fact, has seen exponential growth in profits in recent years. Its quarterly numbers, or rather profit, has increased from 6 crore in Q1 FY20 to 48 crore in Q1 FY21 and further improved to 121 crores in Q1 of FY22. While the current trends are extremely encouraging, Angel's business is dependent on capital markets and hence it's inherently cyclical. The sustainability of the recent improvement in earnings profile hinges on high trading volumes, which in turn are dependent on the level in equity markets. The current high trading volume and client additions may not sustain if markets remain range-bound. Interestingly, the median age of clients acquired by Angel in the last 2 years is 29 to 32 years. Now, this age group may not have a huge saving surplus and hence their ability to sustain down cycles is also debatable. Angel's revenue is highly skewed towards broking income with negligible distribution income. Now, this means significant volatility in markets will directly impact the company's broking revenue, and that can put pressure on the overall earnings profile. On the contrary, ICICI Securities has a diversified revenue profile with a leading position in distribution business and an equally good standing in investment banking. ICICI Securities is the second largest distributor of mutual funds among non-banks. Gross commissions earned from AMC stood at 264 crores for ICICI Securities compared to 7 crores for Angel broking in FY21 according to AMFI data. ICICI Securities' average mutual fund assets stood at 44,000 crores as of June end. The street is assigning too much weight to discount brokers and new age disruptors. The astronomical valuation of discount brokers in the private market implicitly assumes that traditional brokers will completely succumb to disruption. But that may not be the case. Several traditional brokers have also shifted their focus on acquiring bulk of their customers digitally, and they too have also slashed charges. For instance, ICICI Securities has successfully pivoted its business model by enhancing digital offerings and reducing its pricing in certain segments to compete with discount brokers. Consequently, the distinction between discount and traditional brokers has reduced substantially, and pricing is no longer a key differentiator. To stay relevant, new age brokers are attempting to diversify their revenue and have started offering products like mutual funds on their platform. But that is a long shot. Distribution of mutual funds and advisory is a highly competitive segment with wafer-thin margins, and building a meaningful asset book may take several years. At the current market price, ICICI Securities is trading at a 20% valuation discount to Angel broking. This indicates that the market is considering ICICI Securities as just a broker and assigning no value to its large and profitable distribution franchise. ICICI Securities valuation is very attractive considering its robust financials. Its profit and revenue have grown at a CAGR of 35% and 18% respectively over 5 years, FY16 to FY21, despite stiff competition from discount brokers. It has consistently generated ROE of around 50% in the last 5 years, and not to forget, ICICI Securities is a bank-led broking firm with much large scale. The stock will re-rate once the short-term euphoria abates and investors shift the focus away from client additions to long-term profitability. Therefore, investors with high-risk appetite wanting to participate in the growth of broking industry over the long haul should definitely look at buying ICICI Securities.